Hi, everybody. This is Peter Schiff. Again, this is Tuesday, April 28th, 2009, and I am still in Orlando. I gave my speech earlier this afternoon. A couple of news items that I thought were worth commenting on today. One of them is I read that President Obama is now committing new money to helping to modify second mortgages, which would include things like lines of trust, home equity lines. Now, as I said before, the best thing that the government can do for the economy and the housing market is absolutely nothing when it comes to modifications. The government should stay out of it completely. There should be no government money to aid in the process. The modifications should take place based on the lenders and the borrowers coming to modifications on their own terms using market forces without any intervention from government. But here's a situation where absolutely nothing is needed as far as modification. Most people who have a second mortgage, if they simply stop making their payments, absolutely nothing will happen to them. People who have second mortgages are not in danger of their homes being foreclosed, at least the vast majority of them, because most second lien holders are not in a position to foreclose, because in most cases there's no equity. Because in order for a second lien holder to foreclose, they're going to have to pay off the primary lien holder. And in many cases, if they go into foreclosure, there's not going to be any money left. They're not even going to fully be able to reimburse the main lien holder. So here's a situation where the government now wants to use taxpayer money to help pay for modifications that the lenders would willingly make on their own without any taxpayer money whatsoever. And in fact, in many cases, the borrowers aren't even under pressure to modify these loans. They're holding all the cards. They can simply go to their second lien holder, and this is not the case where the liens have been securitized. That's generally the case for first mortgages. If you've got a home equity line of credit, if you've got a second mortgage, you know exactly who your lender is because you went and borrowed the money. The loan wasn't repackaged and sold to the Chinese. So this is a situation where the person who has a home equity loan has all the cards because they can go to their bank and say, look, let's come to some kind of a modification or I'm not paying you anything. And in fact, in most cases, what people should do with their second mortgages or home equity loans is simply stop paying because nothing whatsoever is going to happen because there is no danger of foreclosure because there's no incentive to foreclose. What these lenders will do is simply do nothing and hope that over time the value of your property appreciates to the point that you now have an incentive to reinitiate your payments. Anyway, second thing I wanted to talk about was the restructurings and the bankruptcies going on in the auto industry. Now I'm hearing rumors of a potential deal which would involve Chrysler's union, their pension fund or their fund that owns their medical trust or whatever, is going to emerge owning 55% of Chrysler. Now, of course, this is contingent on the creditors accepting these terms and Fiat are willing to come in with a 25% stake. But the problem here is that the plan preserves the union. And not only does it preserve the union, it empowers the union by giving union control of the company as well as control of labor. And remember, one of the main reasons that companies like Chrysler are broke is because for years the managers routinely caved in to unreasonable union demands. Now, of course, part of this is the fault of managers, and a lot of this was the incentives that were in place because the guys that were running the company, they didn't want to go through a strike. They didn't want the hit to their earnings because they were afraid of the short-term impact on their stock price and how that might impact their options plans and their payment plans. So they kind of went along. But the unions are a big part of this problem for making the demands in the first place. Obviously, if we entrench the unions, if the bankruptcy process doesn't eliminate a lot of the union contracts but preserves them and actually enhances unions' power, we've accomplished nothing. Chrysler's simply going to go back into bankruptcy again because nothing has changed. They might be out from under their debt, but they're simply going to run up additional debt if they're going to have to continue to make cars based on union rules and union pay scales that are in existence. and it's not going to make any sense. Look at what happened when we gave the unions. UAW got control of United Airlines. That company went right back into bankruptcy. And of course, what I think is going to happen here is that now you're going to have the government coming in for another bailout after the union-controlled Chrysler needs more government aid. Now there's going to be even more pressure on the government to bail them out. We need to clean this process up right now. We need to let a bankruptcy proceed without the government intervention. And I think Fiat, I mean, they're hoping that Fiat is going to take 25%. They would be nuts to buy into this company. Why would they want to be a minority shareholder when the company is controlled by the unions? Because obviously there's a conflict of interest there. The unions are going to be more concerned with their short-term wages than the long-term viability of their illiquid Chrysler stock. And I'm sure they're going to hope that any of their future retirement needs or their health care needs are going to be funded by government bailouts. So we need a real bankruptcy proceeding for Chrysler, and we don't need to set this example. We'll find out what actually happens if this plan actually is able to be pulled off. But all it's going to do is preserve an inefficient Chrysler and prevent a more meaningful restructuring. Let's hope that something like this doesn't also take place at General Motors, because that's the last thing that this country needs. Also, quickly on the markets, the dollar did manage to surrender the gains that it achieved yesterday, which was my forecast. We'll see what happens in the short run. I still think that there's a lot of pressure on the dollar. It hasn't completely broken down yet. We did have that outside week last week, but we still have some support levels that the dollar hasn't taken out. Meanwhile, U.S. stock market, again, to me, continues to look like the bear market rally may have come to an end. It's a little bit too premature to say that conclusively. But if you look at what's happening in the bond market, the long-term interest rates are very close to breaking out to the upside, and the bond market is very close to breaking down. And a lot of people are going to try to interpret rising bond yields as a sign that the economy is turning the corner, that we're out of the woods, and that there's economic growth. But my take would be that it's a sign that the bond market is finally starting to appreciate the inflation and the risk to the value of the dollar. Not that they think that the government's plans are going to succeed in stimulating the economy, but that they're going to succeed in stimulating inflation and debasing the value of bonds. Anyway, that's it for today.